Well, hi, everybody. Welcome to this week's Middle Class Investor. This is Seth Martin, your host. It is January 5th, and we're looking at a chart of the S&P 500. I just want to call your attention to this red channel here. This red channel is what we're calling the primary trend. This trend channel goes all the way back to the 2009 low. So this is the bull market channel, okay? And what you want to notice, I'll zoom in and we'll discuss it a little bit more in detail. But, the zoom in, hold on a second. I may not be able to zoom in that tight. Let me see. Yeah, there, let's try that. Okay, so what you want to notice about this channel is that it was all the way back to 2009, it was acting as support, and we had a break. We're going to talk more about support and resistance later on in the presentation, but I want to just discuss the S&P 500 and the broad market as it stands right now. So we had a break. We had a break of this channel. We hit the 200-day, or in this case the 200-week moving average. Bounced off of it. Now it's hard to see here, but you can kind of see a little zigzag pattern, and probably we'll have some follow through next week, a little higher, up into the underside of this channel. That happens a lot, and then what you'll see is, the market generally will fall away. Now, the psychology. I just want to touch on this again because it's real easy to watch, financial news and everybody gets all excited because we had an 800-point up day or a 1,000-point up day or, whatever. And those are exciting if you're a trader, if you can, get a big chunk of that throughout the day. But as a 401k type investor, that for you is noise, okay? Just want to be clear about that. You are not capturing, you're not getting in your 401k at the beginning of the day and getting out at the end of the day. That's not what's happening in your 401k. So it's really, you don't want to focus on that, okay? I'm not saying it's not good or it's bad or it's whatever. I'm just saying it's a distraction for what you're trying to accomplish in something like a 401k or an IRA. So focus on support, these moving averages, test of support, things like that. The trend. These are the important tenets or principles of technical analysis. Which today we're going to talk about support and resistance. Last week we spoke about trend and trend, support and resistance, volume. These are all principles of technical analysis that I want to cover with you. Because really, if you can learn technical analysis and learn to look at a chart, you really don't need to know what the fundamentals of Facebook are, or what the fundamentals of Amazon are, or what the fundamentals of anything are. You can just see what the market participants are telling you, and then ride that wave. And again, we're going to cover that more in a second, but I just wanted to cover what happened this week in the market because it was substantial. So we've had 2 weeks now of up move with a kind of an in between down move, which if you look at and we can here, let's just go to a daily chart real quick, and you can kind of see the ABC there. Now I think we've got to go a little higher. In fact, I've got this zone right here around what is this, 2570 area, and I think that's probably a good area to start seeing this slow down. We'll probably get some sort of pop with a sideways or slightly down, and then another pop. So there's another down up sequence to go in this counter trend, likely. Okay, there's no way to know for sure, but that's likely what's going to happen. All right, real quick, let's look at the VIX. The VIX was down, as you might expect, since the market was up. The VIX hit up here just above 35, which we talked about. We talked about it breaking above this area. Let's get back on a weekly so we can keep track of. So we talked about it getting up above this area. I think I was actually focused on this area, but it did break this area, and now it's pulling back. The 10-year might be done. It's looking like it could be done. It's pulled back into the area that we thought here. This support zone here below these two pivots here, and it could be that that the 10-year is done, and we'll see. Now the short-term interest rate, let's see, where is that? That is the 13-week or the 3-month. Get it off the log here. It's kind of flattening out. It's just trading above and below. It's hard to, zooming in really doesn't help on that. You can almost kind of see a sideways trend right in here, where this has been trading for the last several weeks. And it's just a pause. I mean, that's what markets do. They go up, they pause, they run up or down, and pause again. Okay. Real quick, we'll look at Germany, Japan. I mean, the rest of the world, that's, let's see, that was Germany. This is Japan. I mean, they look very similar. All these markets look very similar. So I don't think there's a whole lot of need to go into great detail around these markets. Let's switch over to TOS charts, and let's look at gold. I think gold, it's clearly taken off. We had this consolidation, this break, retest of the downtrend line, and then it's been up ever since. Now, again, let me go to a weekly. I think what you're likely to see, and this box is probably a little bit low. We can probably move it a little higher. You probably see this is the important pivot right here. In fact, let's draw that in real quick. The reason, let me just tell you why this is the important pivot, because you may be going, well, why is he picking that one? I mean, that just seems kind of arbitrary. The reason this is the important pivot is because this was the low. This was the most recent low. So this was the move. This was the move off that low. So this becomes the pivot now that will provide resistance. Okay. All this right here was just chop inside of this pivot and this last pivot where, you might want to take some sort of action. And we're likely to get up in here just below 1500 before gold rolls over. So that's, again, don't listen to me, do your own research, but that's what I see. Now, we've talked about this before, but you can only trade or invest what you see. But if you watch me long enough, you'll learn about these pivots, where, which pivot is the important one. Well, it's the one off the high or the low, the most immediate high or low. The reason this is not an important pivot is because it's not higher. See here, it's not higher than that one. It's below that one. So this is the important high here that we want to look at, and we want to take a pivot. We want to take a zone off of this pivot. Okay. Hopefully that's clear. If not, just keep watching. I mean, I use the same techniques over and over and over again. Okay. So here's silver. Same thing with silver. Different kind of pattern, but here is the important pivot. So, look for silver, to get all the way up into this 22 area. In fact, let's draw a box. Boxes are helpful. So I want to come just above the highs here and make a box like so. It's very arbitrary. It's just a zone. It's just something to help your eyes see, an area of resistance in this case. Or support would be below the market. All right. Euro US dollar. I think this one's an important one right now to focus on. Here, let me just draw the important pivot. So we get used to seeing it. The important pivot is here. So that's going to provide our resistance. Now there'll be shorter term resistance levels, like this right here is going to provide some resistance. This area I have in yellow or gold. But the major resistance, the area that you probably could trade for, is right up in here. Okay, and I've got it here also marked with this red line. The red line, you know, a lot of times I'll be conservative, so I'll if I'm long, you know, the euro, I'll go ahead and take my profits here at the red line. But I'm not surprised if it goes a little further. Okay. All right. Hopefully that that makes sense there. All right. Let's look at oil. I think oil, you know, is pretty important. What's happening in oil? Getting a little bit of a bounce here in oil. Oil. Let me back out for a second. Oil. You can kind of see this ABC move here, but then you got some sort of consolidation potentially setting up here, maybe in a triangle, and you can see that I've kind of got one drawn here. So, I mean, I'm looking for oil maybe to come down into this area and then bounce, and so on and so forth. Now, ultimately, I think oil is going to make new lows somewhere below. Well, I can't even get. I need to get on a much larger chart. Man, for some reason, it's not letting me go out very far. But I think oil is going to ultimately make new lows back below the previous fourth wave low. This is potentially a new fourth wave. We'll see. I don't know. But certainly oil is in a downtrend and could have a pretty good rally here. I mean, it could rally all the way back up to, you know, 55, 60 bucks. But just keep in mind that the downtrend, it's in a downtrend. Okay? All right, let's switch over to the presentation. Today I want to talk about support and resistance. It's a pretty simple concept, but you know, you have to get used to seeing it. That's the key with support and resistance, is being able to adjust your eyes to what you see, so you can find opportunities on the chart. So, just let's look at the title here. I got support and resistance give vital information about where other traders and investors see value or see overvalue. Okay, so that'll probably become clear in a second. Support is defined as an area or zone where price tends to settle after falling. So, you know, if price is moving down, you know, you can look left, and there's usually a place where, you know, it'll provide some sort of support, and then you can look for trades or investing opportunities at those levels of support for long positions going long. Resistance is an area or zone where price tends to bump up against after rising. So, you know, we use the pivot technique, but it could be any low or any high on the chart that can provide resistance. And we'll look at it could also be a moving average. We'll look at a chart here and you know, give some examples. So, an important principle of technical analysis when it comes to support and resistance is a break of support becomes new resistance. So, if a market's downtrending and it breaks a level of support, an area where you think maybe it would bounce and go up, this is what they talk about: buy the bounce, buy the dip, or whatever they call it. What they're talking about is they're talking about the market pulling back to an area of support and then bouncing, and that does happen. I mean, you know, it happens a lot. In fact, it's happened a lot over the last 10 years. So, buy the bounce is basically, you know, not when this happens, but when a stock or something pulls back to support and then starts to bounce, then that's an investing opportunity. A break of resistance becomes new support. So, if I had this overhead resistance, let's say the market was trading sideways for a long time, and then all of a sudden popped out. Well, now all this price action becomes support. So if the market pulls back, you know, you get support. Now you've seen this before. We've shown this before, like on a downtrending, we'll draw a diagonal down. So like so. Let's say, price is doing this, and you'll see me come in and draw a diagonal like this. Okay. And then when price pops out of there, it tends to pull back to the diagonal and then go. So your buy point would be somewhere in here, let's say. Okay. So this can provide support. Okay. A downtrending line that breaks out can pull back to support. This line here would be support. hopefully that's clear. All right, there's different types of support and resistance. We've covered some of them here. I didn't list all of them, but moving averages can be areas of support and resistance. Just a zone or area on the chart that's maybe related to a pivot or to a long run of price action. That can be an area of support and resistance. Gaps can tend to be an area of support and resistance. So when a market gaps up, let's say, a lot of times at some point along the way it will fill that gap and then take off. So look for gaps. Learn to see with your eyes. Different style of investing, trading leads to seeing things differently. So what I'm saying here is, if you can't learn to see it, it's hard to take advantage of it. It's hard for you to take advantage of what I see. It's better for you to learn how to see these things and then take advantage of them yourself. That's why it's very difficult to listen to other people and what they think, because what they see or what their analysis is may lead to a completely different conclusion than what your analysis leads to. So that's why you really shouldn't listen to other people. Even though you're listening to me, I will qualify it and say, look, do your own analysis, do your own research, and then make your own decisions. All right. Here's a chart of Facebook. It's a very popular stock in 2018. And you can see here this purple line, which is the 200-day moving average, provided support. Now, notice it's a zone or area. In other words, it actually broke through here a couple of times, but it ultimately held, right? This is what I meant by when I said it's a zone or area. It's not a hard line. If it were a hard line, then, let's say you were in Facebook, you would just get out right there, right? But clearly you would have been wrong. So when you're using moving averages, you got to kind of use a zone. Think of it like a fence. It's not a wall. It's funny, fences and walls, talking about that with all this political talk. But you know how you can lean on a fence and it'll give a little bit? That's kind of what support and resistance are. It'll lean on this moving average a little bit and then bounce. And then, depending on what you're trading, if you're trading options or if you're trading stocks or whatever, you might use some of these shorter term moving averages to get out of your position and then get back in when it breaks back above. You have to kind of develop your own rules. So you should look at a bunch of charts, look at the stocks that you're interested in. Stocks tend to repeat, or rhyme. History doesn't repeat, but it rhymes. That's the way stocks are. So you can see, it kind of chopped around here a little bit, and then it moved up. But this is the way markets are. They consolidate. This is a consolidation, and then they trend, and then they consolidate, and then they trend, and then they consolidate, and then they trend, so on and so forth. So, that's why breakouts are important. If you want to look for breakouts. So you had this consolidation, and it broke out right here where you can buy right here, and you can capture all this. A lot of options traders do that. So maybe that'll help you think of something there that you might want to take advantage of. Now, another thing is, and this is not a great example, but let's look at this 200-day moving average. 200-day moving average is right here. Now, some investors will say, break at the 200-day moving average, I'm out. Some will wait for the retest. So break at the 200-day moving average and then retest right here, I'm out. So I'm in. I get the 200-day moving average, but it comes back up. So this could have been a bounce, right? But it comes back up and rolls over. falls through, goes back up through the 200-day moving average, I'm out right here. That's some people's rule. Okay. Now, obviously, they would have missed out, right? But this is the way investing is. I mean, you don't always get the top, and you don't always get the bottom. Another area, look at this gap. This is a gap right here from here to here on Facebook. So here's the danger. You know, let's say you're in this, right? So you're in this because you want to capture all the way to 219 or whatever it was. Well, all of a sudden, you're out at the 200-day moving average anyway. If you have a sell order in, and you just, I don't know, this leaves you kind of feeling like you're an idiot or something. It doesn't mean you're an idiot, but you just somehow get the feeling, you know, when you hold over earnings and you lose that much of your profits. So maybe it's better to just take profits here, forego all this, and go find something else. But what I want to point out here is the gap down, and then it ran back up to the 200-day moving average and fell, and then ran back up to the 200-day moving average and fell. So the 200-day moving average for Facebook is definitely resistance. Now, it was support for a long time, so what do we say? When support is broken, support now becomes resistance. So that's what I meant by support. A break of support becomes resistance, and a break of resistance becomes support. So, for example, if we go back a little bit earlier on Facebook, well, we can't see, but let's say there was some point where Facebook was trading below the 200-day moving average and gapped up below and came back and retested. That would have been a good buy point, you know, because, you know, Facebook's likely to hold support at the 200-day moving average. Now, I'm gonna get out of the presentation and go to my charts real quick, and we're gonna go back to let's look at the SPY, and we're gonna talk about support and resistance. So here's an example here. We were below the 200-day moving average. We broke the 200-day moving average, came back and retested right here. So let's zoom in on this. Okay, so here we are. We're trading. We touch the 200-day moving average. It's resistance right there. Falls. Now it busts through. Okay, but then it comes back and it retests and bounces. So maybe you buy right in here. But then look, the 200-day moving average held for a long time. I mean, even through the 2016 lows. Actually, this is the 200-week moving average. Let's just change it to day. See what it does. See here, all these little places along, just follow the 200-day moving average. So you could use this 200-day moving average as a tool, as a support and resistance tool. You should use whatever works for you, right? But here you had a break of the 200, chopped around, and I don't know, a month and a half later, it came back in, and then maybe right in here is where you buy, right? Of course, then it ran up and pulled back almost to the same price, but then it kept going. It kept going. So the 200-day moving average is a good place. The thing about the 200-day moving average, you have to be very disciplined about where you buy, because first of all, it's a long time. It takes a long time. If I buy right here, you know, let's say I buy right here, but I get out right here because I get nervous, which happens. Okay, well, you just lost a month and a half of investing time, and you lost some money. So it'll keep you from trading a lot. But a long time goes by. It's a long time before you figure out whether I made money or lost money. I guess that's the easiest way to say it. Best way to look at this, I think, is just, well, let's go back and look at it here. Let's say you were looking at getting in Facebook. It breaks the 200-day moving average, pulls back, but it doesn't bounce, right? I mean, so you could have got in right here and then bounced and then sold out, okay? And then it hits, and that's resistance, comes down, breaks here, runs up, so you're not in yet, but then let's say you get in right here. Okay, well then you're going to make a lot of money in Facebook, because even right in here you're still in Facebook. So let's say you got in right here around 200, and it ran all the way to almost 300, and then it broke, retested, so maybe somewhere in here around 276 you get out. So you made, $76 a share. That's not bad. That's 35% or so. But that's support and resistance. Okay. The other area that I want to mention are pivots. And we talk about pivots all the time. This is where I draw sorry about that. This is where I draw those little yellow boxes. So this is the high. Okay, I want to try to explain this in a way. So before we even see any of this other stuff, let's just get it all the way over here. This is the high. This is the run up into excuse me, the run up into the high. So this is the important pivot right here. Okay. So there's going to be resistance right here. Okay. Now the important pivot on the downside is it made a new low, right? So I've got a pivot right here. Okay, that's important. So I want to be able to draw a support area down here, like so. So let me zoom back out and let's look at these and see how well they did. Okay. So a box here around support, around resistance. Okay, and then one here. Now we've talked about this already, but this broke support. This is a break of support right here. Now again, when you break support, sometimes you retest it. So, and it should become resistance. Now the resistance may come in, somewhere in here. Or it may come in at this moving average, but this zone should be resistance. Okay. Now sometimes it's not. If I get two or three closes above this yellow box here, then you might consider this not to be resistance. But generally speaking, certainly in an uptrend, what'll happen is the market will come right here, it'll bounce, and you can take long positions right here to new highs. Okay. But that's not what happened here. But notice the resistance worked out well. We came off this important high, we put in a pivot box, and look where the market stopped, basically right there. Now, on the downside, again, it didn't stop, but that's okay too, because this is telling you that there's potentially a trend change here, which we've talked about. The higher highs and the lower highs and the lower lows and so on and so forth. So, these pivot support and resistance areas are very helpful, and you should practice learning them. Again, you can use them on different time frames. So let's say I go to a 15-minute chart. Okay, where's my important high? Let's say we were back here. Where's my important high? Our most recent high is right here, right? So my important pivot is right here. Right? Okay, so let me zoom out. Gosh, all this clicking is annoying, I'm sure. And let me put in a box here off of this high. And you can see that, you can pretty much see that we're at resistance right now. Now, this is on a 15-minute chart, so it works in all time frames. Okay, there's important highs and important lows in every time frame. Remember, I've said this before, but the market is a fractal, and all that means is that these patterns, when you zoom in at smaller degrees, it looks the same as this. So I can zoom in and zoom in and zoom in, and the market at all time frames will look like this. That's what fractal means. And because it's a fractal, you can actually trade any time frame. You can trade weekly, you can trade daily. Now, if you're in a 401k, we've talked about that's mostly you're looking at weekly information. But if you're a trader, a day trader, you might be working off a 15-minute chart for support and resistance and a 3-minute chart for your entries and exits. That's very, very common. All right, so that's really it for support and resistance. I hope that was informative. I hope everybody got a little something from it. Investing and trading does not have to be complicated. It can be very, very simple. You just create some simple rules. You have some simple principles that you adhere to, and then you take action when your rules are triggered. That's really it. People make it a lot more complicated, and they start adding a lot of different oscillators and things, and then they want to rely on one oscillator, and then they lose a bunch of money with an oscillator, so they want to search around for a different oscillator. This is the wrong approach. Okay, just trust me when I tell you, because I've been there, done that. It's better to keep things simple, trade less, look for good opportunities, and be decisive on your entries and exits. That's what you need to do to make money. So practice, ask questions if you have questions, and we'll be back next week to do it all over again. Thanks a lot, everybody. Thanks for coming in. We'll see you then. Bye-bye.